Mark Douglas, a trading coach since 1982 and author of The Disciplined Trader and Trading in the Zone, emphasizes that achieving consistent results in trading, meaning generating a reliable income, is a major objective for traders. He has worked with significant figures in the industry, including hedge fund managers and large floor traders. Douglas identifies a primary obstacle to consistent results as trade execution errors, which he attributes to a lack of confidence or trading with fear. He asserts that trading without fear is a learnable skill that professional traders have cultivated, distinguishing them from typical traders. This skill allows professionals to enter and exit trades with confidence and ease, fully leveraging their trading methodologies. His entire workshop series aims to provide insights, understanding, and specific mental techniques needed to learn this skill. He explains that physical skills are minimally necessary for trading, which can deceptively make trading seem easy. However, sophisticated psychological skills are crucial for achieving a consistently rising equity curve. These skills are primarily founded on learning to trade without fear, as fear is the root cause of nearly all trading errors and affects the perception of market information. Douglas contrasts the goals of typical traders with those of professional traders. While anyone can make money in trading, consistency is the hallmark of a professional. A professional trader can make consistent money, reflected in an equity curve that consistently rises with normal drawdowns representing only normal losses inherent in any methodology, not errors. In contrast, typical traders often experience boom and bust cycles, characterized by huge losses and drawdowns, which Douglas attributes almost always to trading errors rather than market events. These errors are financially and emotionally damaging, making recovery difficult. Key psychological skills necessary for consistent results include learning an edge, acquiring a trading methodology that offers a higher probability of one thing happening over another, having a plan, defining how to utilize that edge, including risk parameters, which is the cost to find out if the edge works, money management parameters such as contract size or number of shares, and profit objectives. Douglas stresses that having a methodology to enter a trade is insufficient without these defined parameters. Flawless trade execution. The ability to execute trades without errors to maximize the potential of the trading plan. Douglas reiterates that trading is fundamentally about execution, and errors detract from bottom-line results. Trading from a carefree state of mind. Aspiring to trade without fear, which is a function of learning to think in probabilities. This means shifting from a trade-by-trade mentality, focused on whether this single trade will win, to a series of trades perspective. Understanding the methodology provides a win or loss ratio over a series of trades. Douglas emphasizes that there's no way to know in advance which individual trade will win or lose, and that there's a random distribution between wins and losses over any given set of criteria. Recognizing and neutralizing self-sabotaging beliefs. Douglas explains that if a trader has a net negative sense of self-worth, making money can trigger internal forces that lead to unconscious trading errors, impacting their equity curve significantly. He offers an anecdote about a floor trader who unconsciously gave away profits due to a belief that money was dirty. Douglas suggests that software can even track equity curves to indicate potential for inordinately large drawdowns due to such beliefs. He advises monitoring one's state of mind through journaling and scaling back position size, if not in an optimal state. Recognizing euphoria. Developing the ability to identify when one has crossed from normal self-confidence into a state of euphoria characterized by a state of complete and absolute risklessness. In this state, traders are prone to making errors, particularly related to position size, leading to overtrading, such as trading 10,000 shares instead of 1,000. This overconfidence can instantly flip into pure, unadulterated terror and mind freeze if the market moves unexpectedly, leading to significant losses. Douglas suggests that advice to stop trading after windfall profits and take a vacation exists because it prevents self-sabotaging beliefs from giving away accumulated wealth. Douglas highlights that unrealistic expectations are a major cause of trading errors. Expecting a specific outcome from a single trade, rather than a probabilistic outcome over a series, leads to defining and perceiving market information as threatening. This taps into four primary trading fears: being wrong, losing money, missing out, and leaving money on the table. These fears cause traders to focus on the object of their fear, inadvertently creating the very experience they wish to avoid. The market's up and down ticks are inherently neutral. Emotional pain arises from the trader's interpretation based on their beliefs. Common trading errors that professionals have overcome include not defining risk in advance. This stems from believing one knows what will happen next, and the fear of being wrong or missing out can prevent gathering evidence of potential failure. Defining risk but not taking the loss. Allowing a predefined small loss to become a much larger one. Hesitating and getting in late, due to doubt or the belief that one knows what will happen next. Jumping the gun and getting in too soon, often after a winning streak, based on anticipation rather than a confirmed signal. Getting out of a winning trade too soon, or leaving money on the table. A common experience for traders. Letting a winning trade turn into a loser without taking profits. Moving stops closer to entry, getting stopped out, and then the market reverses in their favor. This indicates a failure to truly accept the trade's risk. Douglas emphasizes that any of these errors can result in a winning trade on an individual basis, reinforcing poor behavior, but ultimately sets the trader up for catastrophic losses. He introduces 3 developmental modes of trading. Mechanical mode. Trading with rigid black and white criteria where all execution decisions are made in advance. The focus here is on learning skills, not immediate profit, and identifying what works and doesn't in both the market and one's own psychology. Douglas recommends starting with position sizes that are completely comfortable to the trader, even as small as 1 share, to execute flawlessly and build confidence. Paper trading helps assess methodology potential, but real money trading, even small amounts, is crucial for assessing one's psychological ability to execute the plan. Subjective mode. A broader, more flexible mode where traders use everything they've learned about price movement to determine edges, stops, and profit targets. Decisions like exiting a trade early are based on recognizing market patterns without fear, unlike emotional exits in the mechanical stage. Intuitive mode. The most advanced stage, akin to a black belt in martial arts, where a trader is in the zone and can see and do things that they can't necessarily explain at a rational level. Douglas warns against relying on intuition until fundamental skills are acquired, as it's easy to confuse intuition with hope or wishful thinking. Douglas explains how prices move. Prices move due to an imbalance in the degree of conviction between buyers and sellers. Someone must be willing to bid the market up or offer it lower. Dynamic traders, for example, hedge funds, money managers, and large commercial entities, have the financial and psychological resources to purposefully move prices. They understand the mindset and behavior patterns of the crowd and use this knowledge to extract money from typical traders. Passive technical traders, the typical public trader, are dependent on dynamic traders to make them winners, as they don't typically cause price movement. They often expect dynamic traders to make them winners without understanding how these large players operate. Douglas provides examples of dynamic traders' strategies, such as false breakouts, which means driving prices just past resistance to trigger buy stops from short sellers, then selling into those orders and shaking out weak longs or shorts, which means purposefully moving the market against less confident traders at the open to buy their positions at better prices. He argues that technical analysis identifies patterns in the collective mind of the market, but cannot know the intentions of individual dynamic traders who can negate a pattern's outcome. Therefore, no technical methodology can tell a trader what will happen next on a trade-by-trade basis. Its value lies in identifying patterns with a higher probability of a certain outcome over a series of trades. Changing one's mindset is crucial. Douglas likens the mind to a slot machine. Understanding probabilities means accepting a random outcome for each individual spin while trusting the odds over a series. This prevents emotional pain from individual losses because the expectation is random, not a guaranteed win. He defines change as a function of desire, clarity of intent, and sincerity. He uses the example of a blind video game player to illustrate extreme desire leading to extraordinary results. Self-discipline is a technique for change, defined as a conscious commitment to align thoughts, words, and actions with one's goals. It involves continually refocusing away from conflicting beliefs or dysfunctional thoughts. He uses his experience of becoming a runner to illustrate building a new identity where desired behaviors become effortless. The goal is to disconnect the now moment from past outcomes. The belief that no two moments are ever alike in the market helps overcome the mind's natural tendency to associate similar events. Douglas suggests adopting the 5 fundamental truths about the nature of trading as core beliefs. 1. Anything can happen. 2. Every moment is unique. 3. An edge is nothing more than an indication of a higher probability of one thing happening over another. 4. There is a random distribution between wins and losses on any given set of variables that define an edge. 5. One does not need to know what's going to happen next to produce a consistent income. To reinforce belief in consistent success, Douglas proposes the trader's creed. A consistent winner objectively identifies edges, predefines the risk of every trade and never violates the chosen risk point, completely accepts the risk or is willing to scale back position size, acts on edges without reservation or hesitation, continually monitors susceptibility to trading errors, for example, through journals, pays oneself as the market makes money available, for example, by scaling out of positions, never violates these principles of success, or at least aspires to never violate them.